Hello everybody and welcome to today's video on Opendoor. So it's time for me to make a little update on Opendoor. I'm done with my Opendoor series. And so I wanted to talk a little bit about valuing Opendoor. And I think there's two types of valuation that we need to look at: short-term and long-term. And in this video, I'm going to try to focus on short-term, even though I'm not much of a short-term guy. I know, I mean, I don't do short-term, but I'm going to try to value it short-term and answer the question, is Opendoor going to go bankrupt or not? Because that's what this investment has essentially become for so many. And I guess I've had some DM and many comments telling me, oh, Opendoor's going bankrupt, Opendoor's going bankrupt. I can't believe you like Opendoor, even like angry realtors, etc. So let me start this video with the premise of what happened with Opendoor. So I bought Opendoor after being a customer of Opendoor. I sold my house to Opendoor and bought my next house with Opendoor, and I was able to coordinate the sell and the buy. I saved a bunch of money on real estate fees, on moving. It was so convenient. You know, this was my fourth home I bought in my life, and the experience was not 10% better using Opendoor. It was 10x better, at least 10x better. I mean the net promoter score of this company is through the roof, right? It's in the 70s. Like this company is a revolutionary company, and yeah, I've never felt that strongly about a company, and then I was like, okay, well, you know, there's plenty of stocks that I like, but I was like, let me allocate a little bit to Opendoor in June 2021. And I allocated just about the savings that they made me save. I mean, yeah, I think Opendoor is amazing business. And of course, you know, had I used Opendoor in 2022, would I have allocated today in 2023, for example, or late 2022? Well, probably not, because the environment has changed. And so I bought a little more a few times when the stock was like near $1, but that, I mean, that was you know, not a lot, because the environment has changed. The environment has changed, and back then, right, back when I bought Opendoor, this is what we had on the news, and you've probably been staring at this and you're wondering what I'm saying here. Well, July 2015, right? Yellen, inflation will settle down, right? So if you look at this interview, she was extremely positive. And nobody thought the Fed was going to do what it's doing now. Nobody thought that. And of course, hindsight is always 2020. But back then, that was not the plan. Like, let me go on. You know, Fed's guidance was pretty clear. Right? Back then, I don't think Opendoor was that risky of a stock. I mean, this is what we had in the second half of 2020. Jay Powell was saying, we're not even thinking about raising interest rates, right? If you knew that, would you have bought Opendoor? You know, maybe not. This is another one of the issues that we had. Like, look at what people were saying at the time. You know, this is going to take a whole lot of time, he said, to raise rates. You know, it will continue record bond buying program. They're going to continue bond buying program, ensuring financial market remain flush with liquidity. At least another 5 years with a lower bond. So if you were looking at the news mid-2021, it was clear that the Fed was not intending to raise rates. And it was very clear to me too. And you know, I guess it's our fault for believing what the Fed says, and I guess you know, I guess it's a lesson learned. And now, of course, I'm never gonna fall for it ever again for believing what the Feds. I mean, they've lost all credibility, in my opinion. They've lost all credibility. For decades, they will have lost credibility because thousands of companies invested according to the Fed's guidance. Tens of millions of investors also invested according to the Fed's guidance. And now, of course, this is happening. we've had companies that invested heavily, families that bought houses, were very optimistic about the new decade, who followed the Fed's guidance and bought real estate. And this is what we've had, right? Tech companies, this is tech companies alone. Like, keep in mind, tech companies are the first one to lay off. We've had 159,000 layoff in 2022. And 2022 is going to be a very, very easy year when it comes to layoffs compared to 2023, because in 20 days of 2023, we've already had a third as many layoffs as the whole year of 2022. So how many more hundreds of thousands of layoffs are we going to have in 2023? Well, my guess is we're going to have a lot. I mean, the news, if you read some of the stories of people getting fired at Google, I mean, the Fed is really hurting innovation. Like the projects that we are stopping, the Fed hurt Opendoor. Opendoor had to fire 550 people, and that delays the innovation, that delays the disruption of real estate. I really believe the real estate needs to be disrupted, and this whole lack of visibility on monetary policy has messed up a lot of innovative companies' plans and a lot of investors' plans, because there is no visibility. And Opendoor, short term, has become a bet on the Fed at this point. At this point, this is how I think the market sees the stock. It's a bet on the Fed. And if the Fed pivots, innovation will be back, and stocks like Opendoor, who have fundamental value creation, like a company like Opendoor fundamentally creates value in the noble sense of the term, right? It's not rent seeking. It's not like a realtor charging 3% when all you have to do is go online and browse the houses on your own. Like, Opendoor is not a rent seeking business. Opendoor is a disruptor. They're the businesses that are going to thrive. I really, really believe that. But right now, they've planned and they've organized the business trusting that the interest rates would remain in a certain way. They've hired, right? Like all of these companies, they've made hires listening to the guidance, listening to not thinking about raising rates, listening to things from the top saying, oh, inflation will settle down. They've made all these decisions. And of course, we know what happened. As soon as Jay Powell got reconfirmed, he did a 180 on policy. We know what happens. So I think this is the swings of a pendulum, and I think the Fed will revert. And bear with me if you don't like to talk about the Fed, but this is essential. Talking about the Fed is essential when we talk about Opendoor, because to me it has become a Fed play. So it's the swings of a pendulum. So we had 2020, employment was way down in 2020, right, with all of the shutdowns. Fed cuts rate. Okay, 2022 and late 2021, the government calculated inflation went way up. Fed increases. And by the way, I believe the whole inflation concept, I mean, I could make a whole video on that. That's the government calculated inflation is not correct. It's not calculated correctly. I believe we've had deflation for many, many years, and we're going to have even more deflation thanks to tech. ChatGPT, just look at that as an example. Anyways, 2023, employment is going to be way down in 2023, as evidenced by the layoffs that are beginning to start. And I think we will cut rate for many reasons, but the employment is going to be one of the big reasons, because that's directly related to the dual mandate, right? It's not as far-fetched as the government can't pay. I mean, the government really is going to run into trouble paying off the $30+ trillion of national debt, but that's twice removed from the mandate of the Fed. This is not removed. This is directly the mandate of the Fed. And so if employment goes down a lot, the Fed will have to do something about it. So I believe that the Fed is bluffing. I have believed that the Fed was bluffing throughout 2022 and kept investing only in growth, only in tech stock, never touched oil stocks, never did any of that. I kept investing just in growth and innovation and value throughout 2022 because I believe eventually this is what will win. Innovation is what is closest to Austrian economics, to creative destruction to Schumpeter. It is much closer to what the real economy has always been and will always be. And Opendoor's value is to me is very, very high. They are not a 30% improvement over a real estate experience. They're a 1,000 or 1,500% improvement. So anyways, don't know that. So why are they bluffing? Why do you think they're bluffing? Well, the government debt has to be rolled over at decent interest rates. Otherwise, most of the revenue of the government is going to go towards paying interest rates. So right now, we're rolling over the trillions of dollars of debt. We're rolling it over at very high interest rates. This is not good. The debt payments is going to be the number one interest payments, not debt payments, interest payments, is going to be the number one expense of the U.S. government if the Fed doesn't do anything about rates. And it's already very, very near that. The deficits are at an all-time high. So we keep having more debt. There is little tax, maybe I'm exaggerating, very little, but there is little tax coming in 2023 because of low capital gains. Who is going to have capital gains in 2022? Very few people. Savvy investors, tax laws are vested throughout 2022. So capital gains, they're going to be very low. And lastly, the Fed has signaled that they're going to hold rates high. So the fact that the Fed signals that, should I assign the same value to this statement as I assigned when I said we're not going to raise rates at all? We're not even thinking about raising rates, right? So we can't trust what the Fed says. We can't trust it. They say they're not going to raise rates. I believe they're bluffing. This is jawboning. This is not talk. Once you don't have a credible commitment, once you've broken your word, then it's really, really tough to believe it. And so when the Fed says, "Oh, we're going to hold rates high," what does that mean? So anyways, and unemployment. Unemployment is a lagging indicator. So numbers will be very high very soon, and inflation will be down. And so I believe the Fed will have the ideal face saving setup for them to start lowering rate in 2023. That is my base case. And I really hope they do for Opendoor's sake, because if they don't, it's going to be a little harder for Opendoor. So what's going to happen when the Fed cuts interest rates? What's going to happen? Well, very simple. The home prices are going to keep increasing in value. We can only build about 1% extra single-family homes every year. And the monetary inflation of the US dollar, in my calculation, is closer to 15% per year. So you have the denominator growing at 15% and single-family homes in America only growing at a rate of 1%. So what's going to happen to real estate? It's, I believe, going to go back up, which is good for Opendoor, and we are going to see another spike. I have very little doubt about this as soon as the Fed pivots. And a Fed pivot, what does that mean for Opendoor? Well, it's all good. It's all good stuff for Opendoor. It means high beta growth stocks like Opendoor rise. It's a risk on. The present value of future cash flow increases as interest rates go down. So that's very, very good for stocks like Opendoor. Mortgage interests decrease, right, when the Fed pivots. So that means that the real estate activity will get reignited. Sellers will be more likely to list their homes because they will get the prices that they have in mind for their homes. And more buyers will be able to buy. So a Fed pivots is only a good thing for Opendoor. And I believe that Opendoor at this point is a call option. As I said in the title of the video, it's a call option on the future, and it's a call option on the Fed pivot. That's what Opendoor is at this point. And I'm heavily exposed to innovation stocks, and I believe a pivot is inevitable. And so all of the stocks that I covered on the channel are innovation-related innovation stocks. So how long until a pivot? Well, we don't know that, and that's a key question. But I define pivot as holding rates steady for a while, or giving us some visibility that a rate drop is coming. And how long? How long until we pivot? Well, my best guess on that, but this is just a guess, is about 6 months. I think they're going to do 25 basis points, 25 basis points, then no hikes for a few meetings, and then they will start signaling that they're ready to ease. That is more or less my working scenario. And can Opendoor survive for 6 months? Well, we're going to try to figure this out with some numbers. But before I actually go into the numbers, let me say that it is irrational for me to invest too much time figuring this out. Because to me, I'm a long-term investor. The reason why I bought this, I'm not a trader. Like I'm not looking for a 5x. Like if Opendoor 5x's from the levels right now, I'm not going to sell Opendoor. You know, I'm a long-term investor, so I'm not going to sell Opendoor even if it 5x's from here. Quite frankly, if the Fed pivots a 5x, a 10x, I mean that's more than realistic. The stock was at $15 like in 2021, throughout 2021, even higher. So, not investment advice, of course. I have plenty of other stocks where I could tax loss harvest, where I would rather tax loss harvest, because that's also why the stock is down so much. So many people are like, okay, well I'm down 90% on Opendoor, let me sell and do tax loss harvesting. Well, I'm good on tax loss harvesting for a little while, and I think a lot of people are. So tax loss harvesting on Opendoor is going to be very low, and I really believe that the qualitative level of the company, like Opendoor, is a very, very high quality company with a service that can't be imitated. Zillow tried, they failed. What is it? OfferPad not doing too well, So a service that took since 2014, so like 5+ years to build to this committed team, and they have network effects. I mean, you can look at my Opendoor series. I did a whole Opendoor series as to why Opendoor is better. So again, if they fail, if they go bankrupt, I'll tax loss harvest at that point. I'm in no hurry to tax loss harvest the stock. And lastly, the most important thing as to why I think they can survive is I don't think they'll go bankrupt because I've looked at the numbers, and I'll show you the numbers. But just know that this is a back of a napkin calculation. I don't have the day-to-day numbers, right? But if you want to have a more, I understand, if you are 100% in Opendoor, you may want to use Datadoor.io and look at the latest number, and you may want to, analyze more closely what Tyler Auckland and Sebastian are saying, because they do this day to day, and you get the numbers before you actually get the Q4 results. But for me, like I said, I treat it as an option now because it's dropped so much, and I'm in no hurry to sell to do tax loss harvesting. So tax loss harvesting is kind of a buffer for any stock that goes down, but I'm in no hurry to sell. So that's why take this short-term analysis with a grain of salt, but I hope nonetheless that you'll find it useful. So let's go. So to answer the question, is Opendoor going bankrupt? All we care about is cash flow. That is really all we care about. We can see that actually the company was trending tremendously well when I bought the stock right before September 2021. The cash flow were going up, and look at March 2022. They were more than cash flow positive. So this company almost did $2 billion in free cash flow. So you can see the potential of the company. And then, of course, the market turned, right? The Fed went crazy. Quickest rate hike in history. Since the history of rate hikes, we've never had a quickest rate hikes. The real estate market comes to a halt. And that means in June 2022, Opendoor but had a negative free cash flow of $2 billion. And ever since, they've corrected course, and they've taken it down in the last quarter to minus $1 billion in free cash flow. Don't forget, earnings are different things. Like net income is a different thing. What they recognize for their taxes is a different thing. Like we care about cash flows. We care about finance, not accounting here. So right now, last quarter, they had negative free cash flow of $1 billion. So, and we care to see, is the account going to hit $0? That's bankruptcy. When there's $0 on the account, that's bankruptcy. So what we can say is that, first of all, they were able to reduce their free cash flow their negative free cash flow, from minus 2 billion to minus 1 billion. So that's about 50%. Can they reduce it another 50% to 500 million in Q4 and to 250 million maybe in Q1 of 2023, and then flat? The goal is we want flat free cash flow so they stop bleeding money. Can they do that? I believe they can. I believe it's well within their ability to do that for a few reasons. Number one, let's not forget they laid off 500 people. That's a lot. That's a lot of money they're going to save. They have a new CEO who is all about finance. She was the CFO. And they've greatly changed their algorithm and made it much more picky, such that the margins per home today are much, 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 much higher. And as a result of that, of course, they buy less, right? Their revenue is going down as a result of that because they're so picky, and they have less sellers giving them their homes because they're only making low offers now. But that's because of the market. So can they do that? Can they reduce free cash flow? Negative free cash flow? Can they reduce it and lean towards zero, towards flat? I believe they can. Now I want you to pay attention to cash, to how much cash they have on balance sheet. So right now they have $1.5 billion in cash, right? The free cash flow, the money gets removed from this, essentially. So clearly, if they have an offer of minus 1 billion next quarter, they're going to be in trouble. Clearly, it's going to deplete higher. But that's where we have to talk, I think, about the most important thing for Opendoor, which is their financing facility. The financing facility is the most important thing to understand for Opendoor. And perhaps it's overlooked when you read at the CEO letter, but this is the last CEO letter. And so they have financier, right? People who are willing to provide borrowing to them. So that's their capital position. And they have a pretty high one, At the end of the third quarter, they had $11.1 billion of borrowing capacity with different lenders, and $8.6 billion of this was committed, meaning that subject to terms, they have no choice but to lend to Opendoor. So that gives them a lot of flexibility. So when you look at the fact that they have, so that's a total of 8.6, they have $8.6 billion of committed borrowing capacity. That means money that they can borrow that we can count on. And they have $11.8 billion of capacity that we may be able to access, but may be taken away. So that's kind of the delta between the 8.6 and the 11.8 has a lot to do with the thesis of Opendoor and how well they do in the short run. Okay, the balance sheet tells us what? When I look at the balance sheet, I see that they have $8.02 billion of debt that we care about. So 8.02 and you have 8.6, right? So you have more than $500 million of borrowing capacity that they still have. So when we add it up, and I'm going to add it up, when we add it up, that's 1.5 billion plus 0.58, and that's the worst case financing that is already committed. That's 2.08 billion. So in the worst case, Opendoor can still have $2.08 billion of negative free cash flow. And my expectation, like I said, is that for Q4, so next quarter, that's coming up in a few weeks, minus 500 million. And then hopefully minus, a few hundred million by Q1 2023. And then hopefully you break even and you become flat Q2 or Q3 of 2023. And then you don't have to worry about that anymore. Hopefully. So that's the worst case scenario. That's what they already have committed. However, there is a best case scenario here, which is, if you remember, the 11.8 billion. Like, that doesn't mean that there are the 30% that are not committed, some of them are still going to land. Like, that doesn't mean they're all running away. So there is a best case scenario. And how much can they lose until bankruptcy in their best case scenario current? So that's $1.5 billion of cash plus 11.8 billion minus 8.02 equals 5.28 billion. So they have about $3 billion right, that they could potentially have in committed financing if those lenders do not retract their offers. And so if you have those lenders that are, kind of said, yes, we would finance but not committed, and you add those to the 1.5 billion in cash, you get 5.28 billion in cash. And in that case, I would argue, given the decreases in negative free cash flow that I expect, I would argue in that case that they are much safer. They are much safer, I would argue. So contrary to, I think, what a lot of people say rather meanly in the comments, oh, we're going to go bankrupt, you're going to lose all of your money. It's not that obvious. And I think you can understand, and if you're interested in that, I suggest you look some of my macro videos, but nobody cares about the Fed, so these videos have no views on my channel. But I've done quite a few macro videos, and I think it's important to understand that if your thesis is that the Fed will reverse course mid-2023, like it is for me, then Opendoor makes sense. No investment advice, but Opendoor makes sense if you believe the Fed will reverse course. Because all of a sudden, all of the metrics change, right? The real estate, the real estate boom, the real estate market can spring back up as fast as it came down. It can absolutely go back up as soon as the Fed eases. And I believe they will have to ease because they have a mandate. And we're entering a recession. And companies are laying off people by the tens of thousands. So they will have to make a move. Politicians don't like to see unemployment. You already see politicians like Elizabeth Warren yelling at the Fed, be like, hey, stop doing that. Anyways, not talking about the Fed anymore. There's one thing I forgot to talk about, which is a wild card, which is how much debt can they place on the old homes that they purchased with their equity. So, there may be a few $100 million of money there. If there's homes that they keep as investments that they bought with equity, can they actually put mortgages on those homes and add that to the cash flow of the firm, to the free cash flow of the firm? Can they do that? That's the wild card. And let me conclude by saying this: we now understand. I mean, we understood that before, but now we understand why it was so urgent to have a finance person become the CEO of a firm. Carrie Wheeler, she was the CFO. She has a great experience in finance. And I think it makes so much sense when you see those short-term numbers to have the CFO become the CEO, which is what happened a few weeks ago. Because I think she will be able to speak to Opendoor's financiers, right? Opendoor's financiers will understand a CFO better than they understand a visionary CEO, which I believe Eric Wu was visionary in creating this company, absolutely visionary. So in conclusion, I don't think they'll go bankrupt. If they do, that's even more tax loss harvesting that will be used one day to offset the gains on other stocks. So, it's never a total loss to invest if you have capital gains elsewhere, because you can offset 15%. But I really hope they succeed, and I absolutely love the company. I love Opendoor. I hope these short-term numbers were helpful to tell you where we stand. Please let me know. There's 2 videos that I could make on Opendoor related to finance and not the quality of the business. There's one about the long-term opportunity, and there is one about the relative valuation to other stocks. So if you're interested in either of these videos, please let me know in the comments, and I will make them. Thank you so much for watching. I admire the Opendoor community. Y'all have been so nice, on Twitter, on the Discord, and you picked the right business. I mean, we picked the right business. Like, Opendoor is the right business. If it fails, it's because really of unpredictable Fed action. That's why. That's the only reason why it will fail, and that means another company will come. Real estate will be disrupted. The playbook is out there now with Opendoor for disruption of real estate. The playbook is there. So anyways, not investment advice, just entertainment. Please like, it really helps get the video out. Please subscribe if you haven't done so. I really appreciate it. I don't cover only Opendoor, but if you subscribe, it really helps me out because it takes a little bit of time to make these videos. So thank you so much and have a great day. Thank you.